Shares for beginners. Phil Muscatello and FinPods are authorised reps of Money Sherpa. The information in this podcast is general in nature and doesn't take into account your personal situation.
One of the core roles of a board, it's really about succession planning and overseeing and developing talent within your management team. So if you're turning over your management team a lot, there's probably two things happening there. You're possibly not recruiting or developing the right people, or when you have put them in place, you're not all aligned and not all on the same page and they're leaving. But both of those situations aren't great for the stability or the long-term performance of the company.
G'day and welcome back to Shares for Beginners. I'm Phil Muscatello. How can you tell the company that you own what you actually think about them? What's the best way to make your displeasure felt? I'm joined today by Steve Mabb, Chair of the Australian Shareholders Association, with some advice on how to blow public raspberries at our not-so-favourite companies. G'day, Steve.
G'day, Phil. Thank you very much for having me back on.
It's great to have you back on, and always good to hear about the great work of the Australian Shareholders Association. So it's been a while since we've had someone from the association on, so just to give us a little potted history about the association and what you guys do.
Yeah, thanks, Phil. So obviously been around for a long time. I think we're over 60 years now that the Shareholders Association's been doing what we do. And that's basically two things. So the first one is education, where we try and, help individual investors on their journey with lots of good information, conferences, a magazine, a website, all of that kind of stuff where you can learn more about, the share market and different companies, different funds, etc. So, lots of that happening on a daily basis. We have 50 meetings all over the country where members get together and talk all things investing and share market every month. And then the other big thing we do, which is quite different, is what we call advocacy or monitoring, where we basically, follow a group of companies, roughly the ASX 200, and we have a volunteer that goes out and meets with the companies before their annual general meetings and works through the issues that they're putting to shareholders to vote on. And then we put together what we call voting intentions for shareholders if they need some help with how they should vote their shares at that year's AGM. So there's not really anyone else that does that on behalf of retail shareholders. There's big, what we call proxy advisors that do it on behalf of institutions like super funds and managed funds, but no one really that does it on behalf of the small or the individual shareholders. So that's where we can come in and possibly help you if you're interested in having your voice heard and knowing what's happening with the structure and, changes and remuneration and the board and all those kind of interesting things that might be relevant to your shareholding in the company.
And these voting intentions are publicly available, aren't they? Anyone can log in and have a look at them.
They are, yeah. They're all available on our website. So you can just go to AustralianShareholdersAssociation.com and there's a little section there on companies we monitor. If you go in there, you can put in the ticker code or the name of the company. And if it's a company that we monitor, you can read the report. Generally comes out a couple of weeks before the AGM. So if the AGM's in November, for example, that won't be up yet. But as we get closer to the AGM and those things are finalised, that report goes up on the website and you can see how we're suggesting you should vote and why. We also put an AGM report on the website after the AGM happens. So once the voting's happened and whatever's happened at the meeting, you'll get a nice concise report of what happened there. And, that can obviously be very interesting for people if they weren't able to get to the AGM themselves. We are, as I said, we only cover about 200 companies and we'd love to cover more, but it's all predominantly volunteer
it's incredible.
based.
It's incredible that you can cover so many with a volunteer base. Yeah,
that's right. And that's why it's volunteers. So, it is a difficult job. It's pretty tough to read an annual report and figure out, what's good, bad or indifferent about those particular issues that you're voting on. So we have a great group of volunteers across the country that do it, but we'd love some more. And if anyone's interested in being a volunteer or a monitor and learning more about the companies and getting involved, we'd love to hear from you because it'd help us cover even more companies.
I find them very educational as well. Once you read these voting intentions and the report that the volunteers have done, it really gives you an incredibly detailed dive into a company, what it does and where the money comes from as well, because sometimes it's coming from unexpected sources.
Exactly, yeah. I mean, we're not necessarily in there trying to give you investing advice. So when we write the report, it's not about, is this a good or bad company to invest in right now? It's more a report on, as you said, where's the revenue and the business been over the last 12 months, and that's all basically taken from the annual report. what's going on with the composition of management and the board, and then the specific resolutions. So when we talk about resolutions, we're talking about things like the remuneration, where basically the remuneration report, so how the management team are being compensated for the year, that gets put to shareholders to vote on. If a new director's up for election or re-election, that gets put to shareholders to vote on. Things like any changes to their constitution, if they're proposing to change, how much money they can raise, or maybe how they hold their AGMs, those things get put to shareholders to vote on. So they're the kind of things that basically shareholders get a chance to have their say once a year. And I know a lot of people don't do that because it is pretty tedious sometimes reading through those reports and trying to figure that all out. And some people just go, it's all too hard. But there is an alternative. If you do want to have your voice heard, that's where the ASA can help you. And we can probably talk about it later, but there's some ways that you can allocate your votes to the ASA if you want some help with that.
No, I think let's talk about it now. It seems to be in the natural flow of the conversation. But that's about proxies. And every time there's a notice of an AGM that we get, hopefully, and by email at the moment, you're asked to vote, but often people don't know what to vote on. But the ASA can look after that for you.
Exactly. So a lot of people will get the email or maybe the notice in the mail saying the AGM's coming up and here's your chance to vote. If you were like me early on, a lot of people probably just delete that or throw it in the bin or whatever because it's all too hard. But the alternative is you can allocate what's called a proxy or someone to vote on your behalf. And that's where the Shareholders Association can come in if you weren't going to vote. You can just write in Australian Shareholders Association in as a proxy, and then we'll vote the way that we think is in the best interest of most retail shareholders on your behalf. We don't know who you are and how many shares you've got or anything like that. It just all gets aggregated together by the registry. So, if you're familiar with Computershare or Link or Atomic, those kind of share registries, they'll just collate all the votes that we're given together and give it to us on the day and say, here's all the votes that you've got to vote at the meeting. So it's all very anonymous. But it is a great way to still have your voice heard as an individual shareholder. And typically we're in somewhere between the top 10 and top 20 shareholders most of the time when we collate all those votes together. So the companies generally do listen to us and are interested in the way that we're going to vote and what we think, because often we do hold a significant number of shares when all the smaller retail shareholders have allocated their proxies to us. We don't get anything out of that. There's nothing financial in it. It's really just about, again, sticking up for or standing up for individual shareholders and making sure their voice is heard.
It's interesting, the remuneration report side of things. I just was reading a little thread on Twitter this morning, and it's this guy who's basically looking at what he calls shitcos and what to watch out for. And he's got this category of lifestyle companies, and where you can actually look at companies and their market cap might be $4 million, and the directors and management are being paid, $2 million a year. And he calls them lifestyle companies for obvious reasons.
Yeah, exactly. I mean, if you look at the whole ASX, I think, there's just over 2,000 companies most years that are listed on the ASX, and somewhere between 2/3 to 3/4 of them don't make any money.
It's incredible, isn't it, when you look at that metric? Yeah.
So what's happening there a lot of the time is that the companies are listing and they're raising capital, etc. And then they're paying, management and the board's wages each year. And eventually, if the money starts to run out, they have to go and raise capital again to, keep funding the company and keep funding management salaries. So I'm not saying there's necessarily anything wrong with that. There's plenty of times companies don't make a profit because they're investing and they're going to grow into a profitable company in the future. That in and of itself isn't necessarily a problem. But certainly, if you've got a company that isn't making money, you do want to have a good look at the remuneration report, I think, and make sure that it's, it's fair and reasonable and that management aren't taking excessive salaries when they're not producing any profits yet, because it's basically shareholders that are funding that at the end of the day. They're having to provide the capital, or possibly they're borrowing money to pay, management salaries and board fees, basically.
Mm. Well, I guess this is a good point to start talking about capital and capital raisings, because I heard a lot of this interview we've based on your recent appearance with TK and Cam on the QAV Investing podcast.
Yeah, absolutely.
Yeah, which was a lot of fun. I'd recommend that to anyone to have a listen.
Yeah, always great to talk to those guys. But capital raising. Most people that have been investing for a while have probably had some kind of capital raising offered to them at some point. And what's happening there is the company's basically coming to the market and saying, we need some more capital. We want to raise some money from our shareholders or potential shareholders. And there's a few different ways that companies do that. So what often happens is the company will go out and talk to investment banks and big institutions and try and raise a significant amount of the capital they're looking for from large institutional type shareholders. And that normally happens before you as a retail shareholder are even aware of it. So they'll ring around for 24 hours and, try and raise a bunch of money. And then they'll announce to the market, possibly before or certainly after that process has happened, that they're raising capital and that they've raised this much from their institutional shareholders. And hopefully they'll then also give their retail or individual shareholders a chance to participate in that capital raising.
The second-class citizens.
Exactly, yeah. So that's where we come in again. We really advocate very strongly that the individual or the smaller shareholders should be treated equally or fairly as the large or the institutional type shareholders have been. So what we really advocate with companies there is that they give the retail shareholder the same opportunity to participate at the same discount, same kind of terms. And there's a few different ways companies can do that. Sometimes they don't do it at all, and we take a very dim view of that. If they only raise capital with the big guys and don't give their small shareholders a chance, we think it's particularly unfair because you basically are getting diluted. They've grown the share of the pie, if you like, but you haven't got an increasing percentage of your slice of the pie. So you basically get diluted. You own a smaller percentage of the company now than you did before the raising took place. So we take a dim view of that. The next option is that they can do what's called a share purchase plan. So that's where they basically can raise up to $30,000 from each individual shareholder. So you would apply for however many additional shares you want, up to a maximum of $30,000 normally. And hopefully you'll get your full allocation. Sometimes they may put a cap on it and they may get even more interest in the raising than they were going to allocate. So they'll scale you back. And that means, let's say they were trying to raise $1 million and they got $2 million worth of applications. They'd probably scale everyone back 50%. So you'd get half of what you applied for so that they still got to their $1 million. So it's not super fair, but obviously it's better than not participating at all because you're not getting diluted if you do want some shares at the discounted rate. The next option, which we think is the best, is what's called a patrio raising. So that's where, whether you participate or not, you get compensated. So if you do participate, you'll end up with the same amount of share of the company as you had beforehand. If you don't participate, the company will compensate you for not participating so that, again, you continue to hold the same amount on the other side of the raising. So that's the fairest way. It is more complicated and probably a little more costly for the company to do, but it is the fairest way to raise capital, and that's what we encourage companies to do. And some companies are increasingly doing that. But before Sydney Airport got taken off the ASX into private hands, it did a patrio raising when it was raising money, which was great. So there's some things to watch out for. And the only other little practical tip I guess we'd give there is that because you don't have to necessarily make the decision on the day that it's announced, it's often opportune to wait for, a couple of days before the closing date, just to make sure that the shares are still trading for a higher price than the capital raising price you're being offered is. Because if they're now at a lower price than the capital raising price, you'd be better off probably just buying those shares on market, for example, than actually paying the higher price that's in the capital raising. So that's one of the advantages you do have as a smaller investor. You can wait till a couple of days before the raising closes to make sure that the price is in the money, as they say.
Okay, well, let's get back to remuneration reports, or REM reports as they're often called, and upcoming AGM. So Qantas, there is so much to talk about in Qantas, and I know Rachel, the CEO, has been doing a lot of media lately about it.
Yeah,
everyone's interested in it. What's the ASA's feelings at the moment on Qantas?
Yeah, look, it's very
apart
topical.
from Mango. Is there anything
yeah, look, it's very topical at the moment. Obviously, there's a lot of news coming out on a daily basis about Qantas at the moment. I think we're talking late September, so who knows where it'll be by the time we get to the AGM. But we've been pretty vocal with the company. We'll be meeting with the company prior to the AGM, meeting with the board and sharing our, concerns and views. And then again, we'll be putting voting intentions together before the AGM based on all that information that we're able to clarify and collect. The annual report, I think, only came out about a week ago, so it's still early days as we're working through all of that. But we're obviously very concerned with some of the, reputational damage that's now been done to the company that's, obviously been damaging for shareholders. And you're seeing that in the, the share price that's been dropping through these last few weeks as more of these issues have been coming to light. We're obviously also concerned about the board, because when you think about what a board's supposed to do, board's really there for oversight and governance of the company. They're not there to run the company, but they are there to oversee management and ensure that management are doing the right thing and protecting all of the stakeholders and looking after the company, making good decisions, etc. And when that doesn't happen, you're very much within your rights as a shareholder to question the judgment and the transparency, etc., that the board has been providing or has, been fulfilling. So we've got some pretty significant questions and concerns now for all of the board, and certainly the chair, who's essentially the first amongst equals on a board, around what they knew, when they knew it, what they're going to do about it. We've seen on remuneration that they've announced they are going to hold back some of the bonuses in the short term while they wait to see how the ACCC investigation plays out. They've also talked about potentially clawing back some of the past CEO's bonuses. So we'll continue to watch that. We won't let that drift off into the sunset. Those will be things that we're, continue to watch and comment on as we put together our voting intentions and our AGM report.
And we were referring to lifestyle companies before, and there seems to be a bit of an aspect. Did you see that Joe Aston article about Alan Joyce in the AFR? It was a few weeks ago.
I've read lots of Joe's columns on Qantas, and Joe's a very entertaining and cutting journalist, but he often does get to the heart of the issue, I find, pretty quickly, and then applies a blowtorch that isn't necessarily being applied elsewhere. So I always enjoy reading Joe's columns and seeing what he's got to say about our companies and our directors and our CEOs. It's always a good read.
Yeah, I think there was a great line where he was talking about Alan Joyce's closing the gap strategy, meant buying the penthouse apartment next door and knocking out the wall in between.
Yeah, exactly. Yeah, no, there's plenty of material for him to be talking about. So, and I don't think it's going to go away anytime soon. I'm sure this is going to continue to drag on all the way through to the AGM, and there'll be lots more, reporting and commentary made over the next month as we get closer to the AGM.
So Fortescue, you were talking with Tony and Cam about Fortescue as well, and about the FFI Green Energy Company, which you seem to be taking a dim view that they're allocating capital to green energy and taking it away from Fortescue, which is actually where the profits are being made.
Yeah, I wouldn't necessarily say that we've taken a strong view on that. It's just something interesting to note that, as you see what the company's, planning and reporting this year as they publish their annual report, things have changed a little bit from where they were a year ago. They've been allocating a certain percentage of their profits to the FFI or the green energy side of the business, and I think it was about 10% that they had been allocating up until now. And I think what they announced was that they're now going to start to review the projects on a more of a case by case basis rather than just an arbitrary percentage of Fortescue's iron ore profits. But what they did also say that I thought was interesting was that the returns on the green energy business may not be as high as they were on the iron ore business. So I think if you're a shareholder of Fortescue, that's just something to be aware of, that they're allocating capital, almost away from the iron ore business or away from, potentially dividends to shareholders into the green energy or the FFI business that's probably going to have a lower return based on what they're saying now. That's not necessarily good or bad. It's just something to be aware of, I think, as a shareholder, that's certainly a change in the business from where it was a couple of years ago. What we'll be digging even more into, though, is what's happening again at board level and what's happening again at management level. There's been a lot of management turnover at Fortescue over the last 12 months, lots of, C-suite type executives coming and going. And that's something, again, that, we'll dig into, because if you think, again, of one of the core roles of a board, it's really about succession planning and overseeing and developing talent within your management team. So if you're turning over your management team a lot, there's probably two things happening there. Either you're possibly not recruiting or developing the right people, or when you have put them in place, you're not all aligned and not all on the same page and they're leaving. But both of those situations aren't great for the stability or the long-term performance of the company. So look, none of us really know what's going on inside a business at that level. We can only make our assessments based on the public information that the company puts out. But as a general rule, we don't like to see, lots of management turnover at a company, and it does, have us dig into, what's happening at board level and how the board are viewing management planning and management succession.
Yeah, you'd think it was a bit of a red light, a bit of an alarm bell going off, wouldn't you?
Well, it certainly can be, yeah. I mean, maybe sometimes there's good reasons for it, but often, yeah, when you do see a lot of management turnover, it tells you that there's some instability or, unhappiness in the team. So it's certainly something as a shareholder you should be looking for.
Are you confused about how to invest? Life Sherpa can ease the burden of having to decide for yourself. Head to lifesherpa.com.au to find out more. Life Sherpa, Australia's most affordable online financial advice.
You also referred to, or maybe Tony referred to, Warren Buffett and how he sees a CEO's main job as being a capital allocator. And we've been just talking about capital a lot in this podcast, but it's often something that a CEO doesn't have experience in on the way going up, that they've actually suddenly now got all this capital to deal with, and how are they going to allocate it appropriately to benefit shareholders?
Yeah, exactly. I mean, if you think about it, there's lots of ways that the capital can be moved around in a business. You can invest it in new ideas, new opportunities, future growth. You can return it to shareholders at dividends. You can just leave it in the bank and earn interest on it. There's lots of ways that you can utilize the capital that you've got in the business. And when you think about, what your CEO's core job is, or probably one of their most important functions, it is to allocate that capital as well as they possibly can. If they don't have a great idea for reinvestment for future growth, they probably should give the capital back to shareholders in dividends or buybacks or whatever it might be. If they've got great ideas and they can get a really good return on the capital, then a lot of the time, it might be better for them to reinvest the capital rather than returning it as dividends. So those are big decisions, and they're not easy things to get right all the time. They probably involve a bit of guesswork and a bit of, crystal ball work and all that kind of thing about what the future's going to hold. But again, that's something you do want to be looking for, I think, in your CEOs is, how well they're utilizing and allocating the capital and what kind of return they're getting on the capital over time that they've got to use in the business. And some things to look for there, again, are, for example, back to capital raisings. If they do a capital raising and they do it at a really big discount, for example, and really dilute the business more than they need to. And you'll see that where there's a significant oversubscribing of the capital raising. That tells you they could have raised money at a lower discount, because if you've got way more people applying for shares than you're allocating, you didn't necessarily need to discount the shares as much. So that's a good one to look at. Are your CEOs, doing capital raisings where they're getting, lots more money in than they needed? And if so, they've probably given away a bit too much. Now, we can all make mistakes, but you want to be looking for a trend of those kind of things with CEOs, I think. So yeah, it's a tough job, I'm sure, to be a CEO and to figure all these things out. But as a shareholder, that's something you really want to watch, how well they're allocating the capital.
And of course, if they're allocating the capital to buying companies overseas, that can be another danger signal, can't it? Yeah,
exactly. Yeah, we were talking about that, I think, on the previous episode. But yeah, there's been lots of unfortunate stories, I guess, of Aussie companies that have expanded internationally or tried to acquire businesses internationally and domestically as well. But only anecdotal, but roughly 2/3 of acquisitions that our listed companies make don't normally work out as well as they're proposed at the time the acquisition's made. And certainly internationally, my guess is it's probably even an even lower strike rate. So that's something you want to be looking for too. If a company's raising capital or using debt or using some of their cash to make an acquisition, just remember that, roughly 2/3 of the time they don't play out as well as the company was expecting for a whole myriad of reasons. And when they do make an acquisition, you want to look at that really closely and make sure that, you're very confident that it is going to be earnings accretive or a good acquisition for the business over the long term. And when it's international, the risks are even higher because it is harder to know what's the detail and what's happening in an international market or, an international business compared to, one domestically that you can be much closer to and, understand a lot more about potentially. So just something to bear in mind when your companies are doing acquisitions. More go wrong than right, and the international ones probably get even less successful over time.
And because it's another one of those success stories, isn't it? Because CEOs and management, they want to talk about how great this is going to be for the business. And so they're pumping this kind of idea up, aren't they?
Exactly. And, sometimes there can be very good reasons to do it. If you're a pretty mature Aussie business, then we've got a relatively small market. We're about 25 million people and it's a pretty, mature economy, I suppose. So sometimes, if you do want to keep growing your business, it may make sense to expand internationally. And if it's complementary to what you've already got domestically, there's no reasons, specifically not to do that. But as always, all these things, the devil's in the detail. So as a shareholder, I think you want to be looking really closely at the specific business they're acquiring or adding on, and what management expertise or knowledge that they would reasonably have to embed that business into the existing one, and what are their chances of success. And again, it takes a bit of guesswork, but wouldn't necessarily say it's always a bad thing that an Australian company expands internationally. It's just the risks are probably higher than when they're just expanding domestically.
And just watch out for that word synergy.
Yeah, that's right. Yeah, I mean, sometimes it can go well. I think we talked about an example recently with Nick Scali, the furniture business, where
that's a local acquisition. Not
that's right, but it has gone very well. So there are certainly times where companies acquire other businesses, and they do get that synergy you mentioned, where they are able to reduce costs by efficiencies of having two brands or two businesses now. So in the case of Nick Scali, they bought the plush sofa business, and it was a different position in the market, I think, and a different kind of customer segment to the Nick Scali core customer. And they have integrated it really well. So when you look at that a few years later, you go, well, that was a really successful acquisition, and that CEO, Anthony Scali, has probably done a good job, along with his team, of integrating Plush into the Nick Scali operation and bringing some of the best practice strategies and operational skills that Nick Scali has to the Plush business. So that would be a time, I guess, for example, now where I'd look at Anthony Scali and go, well, he's done a good job with capital allocation there. That's probably going to give me a higher degree of confidence in the future if he looks to do another acquisition at some point. It doesn't guarantee it'll go as well next time, but it gives you a bit more confidence that they've obviously done a good job with their due diligence and their planning on this first acquisition that they've made as a company.
I also just wanted to point out, in terms of getting in touch with management or hearing what management have got to say directly, as analyst calls. Now, it's pretty easy to jump onto an analyst call, and you're presuming that the analysts that are asking the questions are some of the finest minds in the finance industries, but often the questions they ask, and I've jumped onto a couple of them over the last couple of years just out of interest, and it's incredible the lack of depth to the questions that are asked.
Yeah. Unfortunately, we don't probably have as many analysts in Australia now as we once did, which means I think they're probably spread a lot thinner than they used to be in terms of how much time they can really devote to each company that they cover. And yeah, I do tune into most of the presentations that the companies that I invest in give, and try and listen to those earnings calls or AGMs, annual report updates, etc., half-year report updates, all those kind of times where management's put on a call or a webinar and speak to their investors. And you'll often have 4 or 5 analysts on that call as well that are from, again, the investment banks or the brokers, the fund managers, etc. And at the end of those briefings, you normally get some analyst questions. And sometimes there can be really good questions from some of those analysts that maybe have covered the company for a long time. But equally, there can be some pretty, skin-deep questions, I think, where it's just a quick, hey, are you going to grow again next year at the same rate you did last year? That kind of stuff. So I guess my personal takeaway from all of this is, listen to those calls if you can and see how your CEO or your management team responds to those questions. How frank and transparent and detailed are they with answering those questions? But feel free to ask some questions yourself. And I've got a few examples of some questions that I'm going to be asking of some of my companies in upcoming AGM season I can give you that are probably a deeper or a more probing question than maybe you'll get on an analyst's call at times.
Okay, let's have a listen to those questions.
Well, yeah, there's a couple.
Hi-fi, isn't it? Yeah.
Yeah, these are just examples, obviously. But, I do, as a habit now, read through the annual reports of all the companies I invest in, and then I, look at the resolutions that they're putting to shareholders to vote on, and in particular, remuneration and the board, because I think they're the two things that are really important to you as a shareholder. What kind of directors or what kind of board have you got overseeing your company? And then how is your executive team being paid and incentivized? So, JB Hi-Fi, for example, I own shares in JB Hi-Fi. Certainly not a recommendation, just, using it as an example of, a couple of questions you might be interested in or might be wanting to ask this season. So they have
it kind of gives you the ticket to the AGM, doesn't it?
Yeah, exactly. That's right. So they have a couple of interesting metrics on their remuneration structure. One of them's around employee engagement. So basically they measure how engaged their employees are every year through some kind of survey, I imagine. And then they report that to shareholders. And that is a really good thing to know, because if you've got a whole bunch of people working for your company that aren't engaged or aren't committed to the business, they're probably less likely to deliver good results compared to someone that is really engaged, that does care about the company a lot more. So what I am proposing to dig into here with them is, how are you measuring your engagement? It's listed as a key metric for management and one of the ways that you're incentivizing management. So, how do we know our employees are engaged, and what's the tool that you're using to measure it to make sure that it's hopefully a really legitimate tool? They also, don't specifically call out this year what are the key financial metrics that management are being incentivized on. So last year, or in previous year, it's been rolling 4-year earnings growth, and they shared that retrospectively. But I want to know what this year's financial metrics are that management are working towards. Is it something that's aligned with me again as a shareholder? Are management trying to grow the earnings per share, or are they trying to grow the revenue, or what's the actual metric? So given that wasn't disclosed, I plan to dig into that and ask them, what are the specific financial metrics? Now, they may not tell me because they haven't disclosed it in the annual report that I could find, but hopefully they'll answer, and you'll then get an idea about whether the CEO and the management team are, working on a metric or being paid on a metric or incentivized on a metric that's, consistent with what you'd want as a shareholder. So there are a couple of examples at JB Hi-Fi. There's another ASX 200 company called Codan, probably not quite as well known to most people. It's a South Australian-based business that's been around for a long time, and it does metal detectors. So they sell metal detectors all over the world for hobbyists and mines and military applications. They also have a communications division that provides communication equipment to first responders all over the world. So think, ambulance, fire services, also broadcasters. So think, Channel 9 showing the cricket. They might be using Codan's equipment to broadcast and interview, etc. So specifically on Codan, they're a bit different to a lot of listed companies. They have quite a small board. There's only 5 board members at Codan, of which one of them is the CEO. And what's notable, I think, is that they publish a skills matrix in their annual report, like most companies do. And I like to look at that to see, what are the skills that the directors that are currently on the board have, and are they the right skills or the best skills to kind of oversee and take the company forward. And what's noticeable this year is they had a couple of directors resign last year that had a lot of military and metal detection type experience over many years. Those directors have resigned. They've replaced them with a couple of new directors this year that don't have the same skills. So what I want to dig with them here is, you've got a small board, but it looks like you're missing some really key skills around someone with extensive military experience, someone with really extensive communications experience, someone with US experience, because a big part of their business is now in the US. So is the board addressing that? Are you planning to add additional directors? How are you going to plug those skills gaps going forward so that we've got some people on the board that are asking the right questions of the management team in the future? And again, hopefully we'll get a good answer at the AGM to those questions. What is the chair and the rest of the board thinking and doing there in terms of plugging those significant gaps they now have on their board, in my opinion?
We'll get back to the show right after this brief message. Why am I buying, holding, or selling a share? If you can't answer that basic question, then you don't have a plan. The best investors are ruthless in executing their plans. I've been fortunate to meet many great investors on the podcast. Tony Kynaston is one of the best. He has a clear and systematic approach to investing that is honest, sensible, and methodical. It's called QAV, Quality at Value. QAV now offer an excellent light plan for only $29 per month. You can follow their buy and sell recommendations and learn the ropes. And the first month is free using the promo code SFBLIGHT. Go to qavpodcast.com.au to sign up. That's qavpodcast.com.au using the promo code SFBLIGHT. Past performance is not a guarantee of future returns. Please read the QAV FSG and consult a financial professional before investing. I receive a small commission for services I recommend, and I only recommend services I use myself. And the Shareholders Association are advocates of diversity on boards. And some people see this as woke do-goodism, but you've had some experiences, especially when you were doing your company directors course, which kind of maybe not changed your mind, but showed you the value of having diversity on boards.
Yeah, absolutely. It's a really interesting point. And I know it can be somewhat controversial sometimes to people around, targets or quotas or whatever you might call it around diversity on boards in particular. And one of the easiest ones to identify is gender, of course. It's easy to figure out how many males and females you've got on a board. And for a long time, the ASA has supported the same kind of principles that the ASX asks for and the Institute of Company Directors asks for, which is at least 30% female representation on board. And 10 years ago, we didn't have that. We had a much smaller percentage of females on our major company boards. And we've been advocating for quite some time to get that up to at least 30%. We've now moved in line with kind of a few of the other super funds as well that are looking for what's called 40-40-20. So that's 40% female, 40% male, and then 20% can swing or move. And why is that important? Well, again, if you think about one of the core or the most important role of a board, it's to oversee the company. And one of the best ways to oversee a company is to have a diverse range of experience, background, knowledge to ask the right questions and probe into the right issues. If you've got a whole bunch of people that all have the same experience from the same background, from the same industry, obviously the same gender at times, it's more likely that they're all going to think pretty similarly and that they may not be asking the question that they weren't aware of or that they didn't think of because they don't have, different experience. So I had a, really good personal experience with this when I did my company directors course. I'd previously, had a private business and we had a board and we were all the same. We're all a bunch of, Aussie guys from the shoe business that all had a pretty similar, history. And as I reflected on it, I realized that, there were lots of things we didn't know or that we hadn't experienced that weren't necessarily good things to be missing on our board. We got a little bit lucky. But when I did the company directors course, one of the things they do there is put you through a mock board scenario at the end of the course. And they'll say, you're a board of listed company X. Here's a problem that you've got. What are you as a board going to do to try and solve this problem? And in my group, they break you out into a dummy board situation. And in my group, we had a lady who was in the legal department of Virgin Airlines. We had a lady that was the financial controller at one of the super funds. We had myself. We had a doctor from one of the top hospitals. And we had a senior officer from the military. And so you get this problem and you all start to read it on your own at first and, see if you can figure it out before you meet as a group. And I read it and I thought, I've got all the answers. I know what to do here. And then realized as we then started to talk about it as a group that the rest of the group were asking some really different questions or coming up with some really different ideas or issues that I just, wouldn't have thought of with my lack of knowledge or expertise from their respective areas. So it really showed me that having a broad, different range of experiences, backgrounds, etc., is much more likely to get you to the right outcome or a better outcome than if everyone's thinking the same and only has the same kind of solution to a problem or an opportunity. That doesn't mean that, people should just get appointed to a board based on their gender, of course, or any kind of, diverse background. Of course, you want to be qualified and have the right skills that the company needs, but equally it doesn't mean everyone should be the same or we should only have all male or all female boards or all the same age or all the same industry. That's not really going to give you the best chance of overseeing the company and managing risk and opportunity. So yeah, just a personal experience, but yeah, I do now see the value much more in why various bodies and folks recommend or advocate for as much diversity as possible, along with, the skill set and the experience that's relevant or right for that particular company.
And let's face it, guys, and especially in this end of the corporate world and the business world, often do suffer from overinflated egos, which women don't
exactly.
seem to as much. That's only anecdotal, but yeah.
Well, there's actually, I've read quite a bit of research actually that shows, again, on average, these things are all averages. Of course, there's exceptions, but on average, women actually get better investment results over the long term than men do as a bucket. So I wonder aloud sometimes why that is. Is it because men are overconfident and they take more risks on average and women are maybe a little more conservative and a little more, long-term in their thinking? Who knows, right? It's hard to know for sure, but there's certainly some good research that's looked at male versus female brokerage accounts over the long term. And on average, the female bucket tends to outperform the male bucket a little bit, which you wouldn't think when you come into our industry and see how many men there are and how many men are in the media and how many men manage funds, et cetera, et cetera. So yeah, maybe that's another good example for why it's good to have a bit more diversity and a range of views and experience around the table.
So Steve, how can listeners get in touch with the Shareholders Association?
Yeah, so the best way, of course, is via the website, australianshareholders.com.au. There's lots of great information on there, plenty of free information that you can access. And obviously the voting intentions are on there, like we talked about earlier, if you're interested in looking at, companies we monitor and how we're proposing you vote at an AGM.
Just tell us in the menu where you get that, because that's in, where is it?
Yeah, so in the menu,
advocacy?
ASX monitoring and shareholder advocacy. So you just click on that little box and go to the drop down that says companies we monitor, and you can you find all the info in there. If you put the ticker code of your company in, it'll tell you whether we cover it or not. And again, just a reminder that those reports generally only go up a couple of weeks before the AGM, so you need to be relatively close to the AGM before you can see them. We also hold member meetings all around the country, so you can normally attend those for free the first time just to come and check it out and see what it's all about. Those are all listed on the website too, so you can click into events or members and see where the next member meeting is, local member meeting, if there's one in your area. And you're always welcome to come and attend and see what the meeting's all about before becoming a member. So there are probably a couple of great ways to find out a little bit more about us. And of course, you can always contact us as well via phone or email if you'd like to talk to anyone and find out a little bit more.
And if you never want to have to think about those pesky proxies again, you can do it in bulk, can't you? And
you can, that's right. So there's really two ways to allocate your proxies. If you just want to do it case by case, that's where you do write in Australian Shareholders Association into your form or the email online. Or if you want to do it, more on an ongoing basis, the other way you can do it is actually to contact the registry, and they can send you a form where you can permanently allocate your proxies to the Shareholders Association for each of the companies that you own. Now, if you do sell your shares and rebuy them, you'll have to redo that, unfortunately. It's a bit clunky, not exactly the way we'd love it to work, but it is easier, obviously, if you're just happy to permanently allocate. And when I say permanently, you can change it at any time, but so that you don't have to think about it anymore. If you are happy to keep doing it, you can just contact the registry, get the form, put your companies in there and write in Australian Shareholders Association, and they'll then each and every AGM allocate your proxies that way to us until you tell them not to.
Yeah, and I just wanted to add as well that going to those meetings, they're a great gateway drug into getting into the association and meeting other fellow investors, and especially people who've had a lot of experience for a lot of their lives as well, that can share their experience as investors and also as people who've worked in certain industries.
Yeah, we've got thousands of members who attend those meetings every month. And as you say, there's lots of wisdom and experience in the room. So particularly if you're newer on your investing journey, they can be a great place to, pick the brains of some people that have been investing a long time in the share market and probably have some, some learnings and some battle scars that they can share with you. And that's the nice thing too. It's very independent. You're not being pitched to or sold to in those meetings by other members. It's really members talking to other members and sharing their experience. Of course, we have guest speakers that come along to the meetings a lot of the time too. So you can certainly hear from a company or a fund manager or an economist or a resource expert or whatever it might be each month. So there's certainly people that come along and talk about their story or their companies. But amongst the members, you can obviously also have a really good, face-to-face chat and pick their brains if that's something that you think could be helpful for you.
Fantastic, Steve. Thank you very much for joining me again.
Thanks, Phil. Real pleasure to have a chat again, as always. And, thanks so much for all the great work you're doing for investors with the podcast. I listen regularly, and I'm sure lots of other people really appreciate what you do too. So thanks so much for getting all these great guests on and sharing knowledge with us as investors.
Shucks. Thanks, Steve.
No worries. Thanks, Phil. Much appreciated.
Thanks for listening to Shares for Beginners. You can find more at sharesforbeginners.com. If you enjoy listening, please take a moment to rate or review in your podcast player, or tell a friend who might want to learn more about investing for their future.